On today's World Insight with Jian Wei, e-commerce champion Alibaba making a big splash at the Hong Kong bourse, a promising start, and more Chinese companies eye overseas markets to raise capital. Is it a trend? And here's our host, Jian Wei.
Hello and welcome to World Insight, coming to you live on CGTN from Beijing. We begin today's show in Hong Kong, where Chinese e-commerce giant Alibaba has gone public with a massive listing on the stock exchange. The listing is believed to be the largest share sale in Hong Kong since the year 2010. Before we go to our panelists about all the latest analysis related to it and beyond, take a look at this first.
It's the largest initial public offering, or IPO, on the Hong Kong market for nearly a decade. Chinese tech titan Alibaba is offering 500 million new shares this time.
This year marks the 20th anniversary of Alibaba, and we welcome this milestone to come home and to list here in Hong Kong.
The company made a strong debut on the main board of the stock exchange on Tuesday, with shares jumping 6.88% in the morning session. The listing is seen as a boost to Hong Kong, following more than 5 months of violent protests and its recent slide into recession. Experts said Alibaba's listing in Hong Kong will allow more users and stakeholders at home and abroad to invest in it.
For Hong Kong's capital market to continue prospering, it needs to welcome more new economies like us. We want to join the market and contribute to that.
The firm's business-to-business division first listed on the Hong Kong Stock Exchange in 2007, but delisted 5 years later. And in 2014, it debuted in the New York Stock Exchange, raising more than $25 billion. But with uncertainty still surrounding China-US relations, the firm is encouraged to find ways to hedge. Alibaba now boasts 960 million digital economy users across China, with annual revenue reaching 411 billion yuan, or $58 billion. Earlier this month, the company posted new record sales on Singles Day, attracting $38 billion in sales in just 24 hours. With social unrest in Hong Kong and barriers in the US, what's next for the Chinese e-commerce champion?
On Alibaba's listing in Hong Kong, we are joined in Hong Kong by Hong Hao, the Managing Director and Head of Research at Bocom International. Also joining us in Hong Kong, Ronald Wan, the Chief Executive of Partners Capital International. Gentlemen, welcome to our program. I'm sure both of you have been talking about the issue from the early morning until right now. But what about the late night wrap? Mr. Hong, what do you make of the performance of Alibaba so far today?
Yeah, very strong performance, especially amid social unrest here in Hong Kong market. The market is willing to look through that, because this is a strong growth company and one of the leading Chinese internet company that is coming back to this part of the world. So I think the market is celebrating it.
Is celebrating it for how long, Mr. Wan? What do you think?
I think the performance of the Alibaba IPO has been really strong. I think the strong performance and the festive feelings and about celebration will last for a while, because we've seen a lot of investors looking for long-term investment in Alibaba, and also I see that a lot of investors are being attracted to Hong Kong, and more tech stocks will be followed by others, listed companies, know, because of the successful listing of Alibaba. I think many good things are yet to come yet.
Well, Alibaba's listing in Hong Kong could be phenomenal, but it is the largest of its kind in the world anyway. So, Mr. Hong, if others want to follow suit, will they have the similar kinds of treatment or responses from the market? That's a big question mark.
Yeah, I wouldn't be surprised to see similar reception towards listing at a later day. I think Alibaba is heralding the trend of Chinese companies coming back to Hong Kong or even to mainland China to get listed. I mean, historically, if you look at the structure of Chinese listing, most of the really good, excellent Chinese companies are actually listed overseas for some reason. Either because of the listing requirements and the listing procedure in the mainland Chinese market is too complicated, or the overseas market could offer a better valuation for the shares. But now, you know, the table has turned, you know, with the increasing competition between China and the US. And I think more and more companies are actually looking to come back to Hong Kong or even to mainland China to get listed.
Mr. Hong, if I could remind you, this is right after 5 months of unrest in Hong Kong. Well, we can make Alibaba a phenomenon, quote unquote, but what about this, the long term? Or for most of the companies, it doesn't matter whether Hong Kong is going to have unpredictability in the future, as long as they earn some bucks from the market for their future investment. That's good enough. Mr. Hong, briefly.
Yeah, I think to a certain extent that's correct. But then, you know, remember that putting money into Hong Kong market is actually investing in a greater Chinese market, you know, because most of the Hong Kong companies' earnings actually coming from mainland China. Yeah. So I would say that, you know, buying Hong Kong is actually buying China.
Well, it's understandable that both of you would rally the crowd about buying Hong Kong, but Mr. Wan, it is with unpredictability of Hong Kong market, even though everybody wants to applaud for Alibaba's performance for today. So what about the so-called model, quote-unquote, Alibaba established? Is it going to be a sustainable model for the other Chinese companies, whether they choose Hong Kong or should they choose other mainland stock exchanges? What do you think?
I think Alibaba's successful IPO shows something. You know, it proves that Hong Kong is still the premier Chinese, you know, international financial center. Or we can say that, you know, Hong Kong Stock Exchange somehow is the international platform of the Chinese market. Whether the company, a company will choose Hong Kong or, you know, mainland other Asian market, it really depends on the structure and the valuation and the competitiveness of the, you know, structure which the stock exchanges can offer. Somehow, you know, if Alibaba model works, you know, a lot of overseas listed tech stocks will pick Hong Kong as the premier, you know, listing place. But for other mainland being incorporated tech stocks, you know, I think that they still have the options to choose Asia's market. I think there is some sort of, you know, alternative arrangement between the mainland market and Hong Kong.
Yeah. You talk about the Alibaba model. What exactly is this model, if you term it that way, Mr. Wan?
I think Alibaba's model is that for overseas listed mainland tech giants like Alibaba. Of course, Alibaba is already the largest one.
The one and only, exactly.
You know, yeah.
There are not many similar ones.
There are some. Yeah, there are not many similar, but still a lot of you know, leading tech stocks, not as sizable as Alibaba. Some of them may choose to, you know, broaden their shareholder base and diversify their, you know, financial base as well, because of the relationship between China and US. I think it is a good alternative for them to look to Hong Kong as an alternative platform, you know, because Hong Kong is the premier financial center of China, and they are returning home. Yes.
And Mr. Hong, of course, if you look at the road that Alibaba took in terms of listing, 2007, the business branch of it, rather, was listed in Hong Kong, but it took it off 5 years later. Of course, 2014, went to the US as well, now coming back to Hong Kong. How do you see this back and forth, zigzagging road Alibaba took? How is that correlates with the fate of Chinese businesses overseas right now?
Yeah. Well, the Chinese always say, good things takes time. I think, previously because of the dual listing shares, dual class shares requirement by the Hong Kong Stock Exchange, Alibaba wasn't able to meet their requirements, so they had to take a detour to the U.S. to get listed. And now that, because of the competition, the Hong Kong Stock Exchange is able to relax the standard, the listing standard, or make the listing standard more friendly for companies. So dual class shares are allowed, and also even for biotech companies who are not making a profit, is also allowed to get listed in Hong Kong as well. So I think the environment here is becoming more friendly, and I think as a result, Alibaba is willing to come back, and I think the market is giving it a warm reception.
Mr. Wan, of course, earlier Hong Kong Stock Exchange were facing one challenge after another. The unrest in the city is one thing, but even before that, there was also the attempt to acquire another company from the UK. Of course, it didn't happen at the London Stock Exchange. What I'm saying is that, so what does that mean for the Hong Kong Stock Exchange? How sustainable will this kind of momentum as a result of Alibaba listing in it be able to continue?
Yes, after the failure a bit to acquire the London Stock Exchange, actually we heard some market news that Hong Kong Stock Exchange is attempting to acquire Spanish Stock Exchange. Of course, that is yet to be proved, the news. But what the Hong Kong Stock Exchange want to do right now is to maintain their competitive edge over other Asian stock exchange, or also over other mainland stock exchange. So you need to prove that Hong Kong is the premier international financial center of China. Given that Alibaba give a vote of confidence to Hong Kong Stock Exchange, I think the atmosphere, and the feelings of the stock exchange has become more confident right now. I think what the stock exchange would like to do is to attract more other mainland companies and other regional companies to pick Hong Kong as the listing venue, to show to the world that Hong Kong is still functioning and the market is still competitive.
Mr. Hong, on the one hand, we see over the past 5 months of unrest in Hong Kong, some of it was targeting at particularly companies originated from China's mainland. For example, some of their branches in Hong Kong, the operating spaces were even destroyed and looted. So how much confidence do you think Alibaba will be able to bring with its listing this time in Hong Kong? Some of the confidence Chinese mainland firms have in Hong Kong as a whole, not just the Hong Kong Stock Exchange, because it takes more than stock exchange in a way to attract businesses.
Yeah, I think it's a vote of confidence by Alibaba's choosing to come back to Hong Kong. It is one of the largest and most advanced technology companies in China, and also it has a virtual presence. Really, it's a scalable platform on which smaller companies can actually build out their presence on this platform. So I think it's a win-win situation for Alibaba, which is taking a listing fee from companies, and also it's for good platforms for smaller business grow. So I think Alibaba is deriving most of its revenue and profits from mainland China for now. So even though there is a unfriendly or even hostile attitude towards mainland Chinese companies, but I would say that being the leading technology company coming from China, I don't think Alibaba should have anything to worry about.
Mr. Wan, of course, Alibaba would enjoy all the cash it could get this time in terms of being listed on the Hong Kong Stock Exchange for its future research, development, and many other areas it wants to develop business lines. But, think about it. How do you think the trend that Alibaba apparently tries to set would apply to the other tech companies from the mainland. Once again, if you look at their competitions toward one another, it's also a big one. For example, in the Tencent, for example, NetEase, for example, these are all companies that are, thinking about the competition among themselves as well. So how would you see that in a way related to this kind of competition?
Yes, of course. We've seen that before Alibaba got listed in Hong Kong, we already have Tencent listed in Hong Kong, which is one of the largest company in Hong Kong as well. Given the latest move of Alibaba, I think this would like to demonstrate to other Chinese companies that what the company need to do is to broaden their capital base and broaden their financial base, basically to tap the investors all over the world to achieve equilibrium and achieve a better valuation in the company. So when the company develops, it can use cash and also use its equity as a weapon and as acquisition tools to leverage on the market and to acquire and to build a global platform and also build 24 hours trading areas as well. I think these sort of models I think Alibaba is demonstrating right now to the other Chinese company. So far, among all the large tech stocks in China, basically Alibaba is the first one to do it.
Yeah, but before we go, I still want to play that footage once and again. Before we go, to let you leave, Mr. Hong, once again, Hong Kong and Shenzhen particularly are now on competitive edge with one another in a friendly way. To attract high-tech companies and also to attract investment in terms of high-tech areas. How do you think across the little river over there will the two cities be able to establish their next stage of competition as a result of the latest news?
Yeah, well, I think Shenzhen is already taking the lead in terms of technology innovation. Hong Kong traditionally has been a financial center and will remain so for years to come. I think the industry structure here in Hong Kong is very much fixed, with property and financial companies taking the lion's shares of the economic structure here. So I wouldn't be surprised to see Shenzhen continue to take the lead in technology and Hong Kong continue to be one of the regional financial center.
I see. Hong Hao, round one, thank you so much for both of you for us to understand better about the latest going on at the Hong Kong Stock Exchange and Alibaba's listing there. You're watching World Insight, still to come on our live program. More Chinese companies eyeing overseas markets to raise capital. Where would they go? Is it going to be a trend coming back to Hong Kong or elsewhere in the world besides the United States? That's up to our 8 Talk right after the break. Welcome back. You're still watching World Insight. The program is coming to you live from Beijing. I'm Tian Wei. Many Chinese companies have listed on U.S. stock markets over the past few years. However, in the year 2019, data shows there were more than 150 Chinese companies that have gone public in the U.S. with a total market capitalization of $1.2 trillion. That's at least some of the numbers we have got hold of. But simmering U.S.-China trade tensions have brought pressure on those companies. Back in September, when the White House moved delisting Chinese firms from U.S. markets, Chinese company shares, including that of Alibaba and JD.com, fell sharply. Earlier this month, Chinese and American officials have had what described as constructive talks by phone on trade issues, but uncertainties still remain, if not more. So how will that have an impact on Chinese firms choosing their destination to be listed in stock markets around the world? For more on that and the latest of Alibaba's listing in Hong Kong, we are joined by Professor Jeffrey Townsend of Guanghua School of Management from Peking University. Meanwhile, in Brussels, we have Carol Lanoux, who is the Chief Executive of the Center for European Policy Studies. Last but not least, in our Beijing studio, Zhi Qiang, Assistant Director of the International Monetary Institute from Renmin University of China. Gentlemen, welcome to our program. Go to you first, Professor Towson. Now, is U.S. still going to be an attractive place for Chinese companies despite of the latest geopolitics? Will Hong Kong and other places becoming more attractive than New York or NASDAQ?
Well, I think Alibaba did a smart move, which is characteristic for Alibaba because they seem to be perpetually smart about just about everything. You've got some rising political uncertainties between the U.S. and China. Access to capital markets is very, very important. They did some very prudent political hedging and opened up, obviously, another access point through Hong Kong. Very smart, very rational. But when you take it a little bit above that, it's actually a pretty nice story because on top of that very rational move, you have a nice story of a Chinese company coming home. There's a lot of symbolism in that. And I think has made the story quite nice, which you heard CEO Daniel Zhang talk about today.
Talking about it is one thing, but Mr. Towson, if I could ask you directly, what does that mean for Chinese companies? Is Alibaba going to set a trend, as our previous panelists earlier trying to suggest?
Well, I think the one big winner in this story is Hong Kong. I mean, they've been trying to position against the NASDAQ, against these sort of, several hundred-year-old exchanges out of the U.S. where a lot of the tech giants are listed. And this was a big win for them. And I think it sets them up very nicely for, let's say, maybe Didi going public next year or some of these, There are going to be a lot of Chinese tech giants coming. There's a long pipeline of them. So. It sort of reversed some of the talk that people talked about 4 years ago about going to the U.S.
Yes. I see. Mr. Lanoux, your thoughts?
Yes.
Your thoughts are also about that.
For us, let's say, I've seen from Europe, this is a different story. Of course, it shows that, as you were saying, as people before were saying, let's say, that China shows, let's say, that it can attract capital back home. But the most important story from a global perspective is that basically you see listings, the number of companies listed in the world is declining in the US, it is declining in Europe, but it's still growing in Asia and above all in China. The same with IPOs. You see IPOs overall at low levels in Europe, low levels in the United States, but growing strongly in China. So it shows for us very strongly, let's say, that the growth pool of the world is in Asia. And which is, of course, a clear warning to the rest of the world. Let's say that China, notwithstanding what we've seen in Hong Kong over the last weeks, notwithstanding with the trade frictions, notwithstanding, let's say, the discussion about is China a market-led economy, I mean, it manages to show that it can attract and grow strong companies in mainland China.
Interesting. Professor Xu, from your perspective, the other two guests have talked about it from, I guess, the Washington, in a way, perspective, and also the European perspective, if I could put it that way. Mr. Xu, how do you see the real nature of the latest move?
Well, I think this is the nature of both political choices and also economic choices. First of all, I totally agree with Mr. Lanoux's viewpoint. That is, the companies getting listed has been reducing by numbers. But the reason for that is not actually there are fewer companies trying to get listed, but they cannot. Lots of companies trying to get listed in New York, in Hong Kong, or even in Germany, and etc. But since the economic cycle globally has recently been cooling down, so a lot of companies just cannot meet the standard. So they just cannot qualify. But on the other hand, there's a huge amount of money flowing around in the market. There being cash in people's pocket. People are just get burned. They will try to invest money out. So there have been very few good quality target for investment going on in there. So Alibaba, like quite a few of its counterparts, becomes the hot pursuit by a lot of the investment.
Right.
So the Alibaba company and the other companies like Alibaba, they become, they get opportunity to be listed both in New York and in Hong Kong. Probably, if they want, can be listed in more markets.
Yes. So will that be the issue here, Mr. Lanoux, that we see giant companies seeking dual listing, triple listing, and probably even more, as long as they can still get warm response from the market? And what would that mean for the market and the other companies that are trying to make their way up? Mr. Lanoux.
We have in Europe less and less double listings because, of course, you have companies which used to be listed as well in the US and in Europe. But these days, the big problem for Europe with what they call this Capital Markets Union program is to grow capital markets in Europe. But so far, we haven't seen a trend, let's say, that Europe's capital markets are really growing. On the contrary, let's say we see more bank financing even growing rather than diminishing in importance. We continue to see the attraction of the US market for listings, like recently Spotify went to the US market, but others as well, and not as a dual listing, but as a single listing, because the US has such a pool of capital and is such a brand, if you're listed in the United States, that it's a key point of attraction for companies to be listed there. Of course, the China story fits a bit for Europe in a difficult way into this, but what I meant to say is that, again, US may be very attractive, but China for us is the wake-up call to say, look, this market or this region of the world is growing still extremely strongly, which you see as well with the number of listings as with the IPOs, and certainly with the size of the IPOs. And I wouldn't say that it's only very large companies. I mean, the numbers were just mentioned before. Let's say you also have many other listings on the Hong Kong Stock Exchange, which are much smaller companies, high-tech companies, whatever. So it is, I mean, it's a very kind of attractive story for China, for Asia overall, but it's, again, a wake-up call for Europe and for probably also a bit for the United States.
Mr. Lanoux is doing a lot of soul-searching for Europe right now. What about for you, Mr. Towson? I mean, is China significant still for the New York Stock Exchange and NASDAQ, even given the geopolitics going on right now? Will there be, as a result of tech companies, quote-unquote, forced to decouple from some of the most important areas, influence also the financial capabilities of the United States and China to couple together? Mr. Towson.
Right. I mean, there is this big question of decoupling, and, at one level it's a discussion of trade of products, at another level it's a discussion of technology. And then recently, in the last couple of weeks, we've heard the same idea applied to capital. Are we going to have U.S. pension funds not investing in Chinese companies listed in the U.S.? I don't really take any of that seriously. I think ultimately Alibaba is a great company. There's a lot of great companies coming out of China. U.S. capital, international capital is going to find them one way or the other because it wants to. They want to invest in great companies, and that sort of overrides a lot of the other considerations. So I think that's probably a lot of talk. I think the capital markets are going to stay free-flowing and without much impact. But I could be wrong.
Mr. Chu, you were attentively listening to your American counterpart talking about that. But, when Mr. Towson said, well, I might not take it that seriously about some of the earlier rumors of a certain withdrawal from the Chinese market or capitalization of some of the U.S. Possibilities. But, to you, what does that mean, really?
Well, I think I agree with Professor Towson. Actually, if you look at the data clearly, you will find out actually China has been opening up more to the foreign capitals. There have actually been more companies with more equities been holding in the foreign investors' hands. And I think, and also, on the contrast, and Chinese companies are going out more and more. They're trying out. You see, recently, just overnight, we see many Chinese companies try to get listed in New York and the NASDAQ. I think this is just a healthy way. So even though we're talking about there are some frictions between the two countries in the trade or etc., but actually the capital market is not lying because people with their real money is investing out. They're not fooling around their money, right?
Well, one could argue so, but the question really is how long-term are people thinking about when they do the investment like this? Mr. Lanoux, even though you are from Brussels, but you have some insights about that as well?
About what? I didn't follow your
About
question.
how China
About
and
what
the U.S.
specifically?
relationship really necessarily going to influence the financial markets, particularly in
No,
the
but I would
investment,
agree
of
with
course.
what the other person said a moment ago. If the Chinese market is growing, if there are good opportunities there, pension funds may make some of a difference, but not too much, because in the end they want to diversify, they want to have good growth prospects, and if China continues to show, let's say, to the world that they can grow companies, that companies can be very profitable, they will continue to invest there. And of course, if there are some problems, they may be hampered to some degree by this, but this will not stop them too much, as long as the China market is really the benchmark, and as long as Hong Kong is basically the financial center for China.
Mr. Chu, of course, over the past few months, if you count back the past history, China has been making quite some efforts to open up its financial markets and also cooperation possibilities. Is that significant enough to lure more attractions from overseas investors?
Yes, I think so. China has been really opened up itself to the overseas market.
What do you mean by really opening up? Are there some specific things that you have in mind?
Yes, of course.
Like what?
For example, everybody knows the financial sector is a core sector of economy in any given countries. So in a lot of countries, they try to have some limit in their capital account, which means if you want to invest in some country's bank or brokerage companies, foreign capitals must have some limits, for example, like 40% or 49% or under. So you don't lose the control rights to some foreign investors. But right now in China, you see, we opened up this limit to the foreign capitals. And we see by the Bond Express or the Security Express, we allowed more foreign capitals coming into China. It's going to be a little bit risky, but it shows Chinese determination to open up more to the foreign capital and the market.
How attractive is it, Mr. Towson? The latest.
The financial market is its own sort of world. It's a little bit on the periphery of definitely of my knowledge. When we move into sort of more the fintech world and something that's a little more tech related, yeah, capital's not the problem. I mean, it's the good companies are raising more capital than they probably should be, or should be raising probably.
Chinese companies, of course, are trying to list in many markets around the world, including the European and Asian stock exchanges. That at least have been some of the responses from the Chinese companies in the press coverage. So what would that mean? For example, companies such as Haier and Huatai have chosen to raise capitals using new overseas investment links as well. Is it part of the trend? Will U.S. still be attractive? Will Asian and the European markets have a potential? Let's ask our panelists once again. Mr. Lanu, I guess in this issue you have more say than your Chinese counterparts and also American counterparts, certainly.
Of course, but that depends on the growth prospects and on the overall governance in these markets. And of course, we see that, as I was just saying, Europe has been struggling to build up a dynamic capital market. Of course, we have some very dynamic pools in Europe, let's say, but overall, Europe doesn't give the perspective of being a very dynamic capital market. US certainly is. But what I would say about China, what may be an issue of concern apart from the capital, is the state of the Chinese banking sector and the concerns which you often hear in the context of the Bank for International Settlements and other organizations, that there is a lot of non-performing debt or a lot of bad debt. And then secondly, probably related to that, is the role of state-owned enterprises. So there are certainly things in China which still have to be worked on, which has to do with opening up the system, making the system more transparent, applying fully the kind of reporting and accounting standards and auditing standards as we have in Europe and the United States, to basically make it even more attractive. So for me, the big proviso behind further development of the Chinese capital market is essentially this: applying the rules which we have in place, certainly in the United States, but also Europe, to make sure that investors are sufficiently protected.
Mr. Chu, respond?
Well, I think it's going to be still very attractive. You know, there's a very interesting case in the world. Every time when the economy is shrinking or the cycle is going down, a lot of good companies are actually trying to use the stock market more to raise the fund. For example, Uniqlo, do you remember the big collapse in the Japanese economy of the 1990s, right? There's no banker willing to lend money to the Uniqlo, a young company, try to open up a lot of branches. In investors' mind, this is just suiciding. But Uniqlo, against all the opinions, no matter what, they still try to get listed, raise the capital in the market. And look at the Uniqlo, how successful they are right now. And only when in this down cycle, the stock market and the one who dare to swim in this market is actually the one who have the confidence. Well, because when there's a huge amount of money flowing in the market, because everybody is floating, you really don't know who is the right swimmer, who knows actually how to swim in the waves. But when the market is going down, when the economy is going down, the true dares can really swim in the market, and you can easily pick up the good swimmer.
Interesting. Mr. Towson, do you agree with that? It's all about the qualities, and as long as you have the guts.
I think for a lot of the Chinese tech companies coming up, the rule will just be, when in doubt, copy Alibaba. So list in the U.S., list in Hong Kong. That's a good, solid solution. You know, get back to business.
As simple as that?
Yep.
Mr. Lanu, do you think that is the viable way?
I think it's a bit more, as I said, let's say there is a lot more homework which has to be done, let's say, just to manage to imitate what Alibaba has done. You have to imagine, if you go to the US capital market, you're supervised by the SEC. The SEC, the Securities and Exchange Commission, is the most stringent supervisor for capital markets in the world. So if your accounts are not in order or you don't respect investor rights, you will have a problem right away. So I'm sure Alibaba has the size that they can cope with this, but I'm sure there are many other companies who cannot do this. Hence my plea, let's say, that there is a lot to be done, probably homework to be done by the Chinese, just to make sure that their market also on supervisory standards, accounting standards, auditing standards, role of boards, is up to the standard as we know it in the United States and to some degree in Europe.
Is also your argument, Mr. Chu, that, if I understand it right, China market is attractive enough, China's potential is attractive enough, whether the areas that Mr. Lanu keep on talking about are going to be addressed in a way that even the Europeans, every one of them, will be informed about the progress. Is it necessary?
Well, yeah, I do think so. Well, right now we're actually talking about Hong Kong. I think Hong Kong is actually a temporary good choice for both sides of the market. For example, right now in Hong Kong, probably they have the most solid and complete standards and accounting method and also regulations among all the Asian markets. So when a Chinese company try to list in Hong Kong, so they have to, to examine themselves more thoroughly and to be law-abiding even more. So this is a good learning curve before they try to go to New York. And also for the companies like Alibaba, when they go back to Hong Kong Stock Exchange, also they're using very similar accounting standards and the regulation method. And also I think it's a multiple win situation. For example, there's a lot of Chinese capitals flowing around through the Shanghai-Hong Kong Express or the Hong Kong-Shanghai Express method. And then they have a chance to invest in a good company, good quality company like Alibaba in Hong Kong. And the Hong Kong investors, they do also have the choices. And also don't forget the #1 capital holder in the Hong Kong Stock Exchange is American capital. So they also get their share. So it's a good stabilizer for the Hong Kong market since Alibaba's quality. But the only one thing we have to note is that don't overinvest, because no matter how good you are, there's still the danger of overinvesting and overheating.
Mr. Towson, the underlying meaning of your early remarks seem to suggest that people know where the money should go, and people know where the qualities are, and people know, particularly investors know, where the potential is, despite of all of these apparent geopolitical conflict. Is that what you're trying to say?
Within the tech world, which is, Alibaba, the Tencent, Didi, this world, I mean, these are very unique companies, and they're coming out of a couple places in the world. They're coming out of Silicon Valley, they're coming out of parts of the US, they're coming out of China. These companies are kind of a peer group. There's good reasons to list in Hong Kong, there's good reasons to list in the US, regulations, access to capital, all this. But also within this, there's a peer group. You know, Alibaba and Amazon are similar. You know, Google and Facebook, you know, they're kind of, they all want to be sort of in the same grouping, and they all want to be basically international tech giants. So there's a lot of value in sort of being in that cohort. So I would expect the Chinese companies that are rising quickly, especially in tech, I would expect a lot of them to dream of going international and listing in the US. I think that's going to stay. And I think a reasonable sort of companion strategy is also to list in Hong Kong and cover both your bets there.
Right. Well, we have to wrap it up. Final words from every one of you. What shall we expect as a result of Alibaba's apparently successful listing in Hong Kong Stock Exchange? Mr. Lanu, very briefly, 20 seconds.
No, but on the one hand, let's say all we heard about Hong Kong over the last weeks is only a secondary issue. Hong Kong keeps to grow and keeps to attract capital. I think the story will continue.
Mr. Towson?
I think they're going to use a big pile of money and get into a bit of a war with Meituan on food delivery.
And last but not least, Mr. Chu.
Good news for all the investors, but hey, watch out, Tencent. Your enemy comes into your backyard.
Wow. There's a lot of warfare analysis over here. Well, thank you so much for the three of you helping us to understand the latest. Chu Chang, Jeffrey Towson, and Carol Lanu. Really appreciate it. And that is all the time we have for today. If you'd like to see more, try to find us World Insight into your search engine. Check out our YouTube channel, Facebook, Twitter accounts as well. From me, Tian Wei, and everyone of our team, thanks for watching. Tune in again next time for more insights across China and around the world.